Hello guys, welcome back peeps here. And in today's video, in today's series, we will talk about liquidity engineering. So this video was requested by one of my subscribers, but also some of my followers on Instagram. So I decided to do a video on this liquidity engineering. So if you don't know about liquidity engineering, for today I will explain a little bit about liquidity engineering and how it happens, so how to trade it and so far. So after that we will look on some of pairs that we took last week but also this week. So stay with me from the beginning of this video to the end. So let's start with the liquidity engineering itself. So what do we mean? Okay, I won't explain about the definition or what, but I just want you liquidity engineering. I just want you to know how it happens, how it looks. So I won't explain about the definition and stuff like that. So liquidity engineering. Liquidity engineering happens, in short, we can short that definition. We can say that liquidity engineering happens when the market breaks the structure like this, but also changes the market directions. So when you see the structure like this, the market maybe the market was in the uptrend like this, and then fortunately market breaks this low here, maybe in the bullish market structure. It means the market has created this transition here, but also before this transition happened, we were having this break of market structure here. This is our BOS. So break of market structure with the transition, when the market create the break of market structure with the transition, we can say that the market has already engineered liquidity. And after this engineering liquidity happens, there's many orders that have been taken here, because some of traders were trying to sell at this low, at this high here, maybe, and then because they were looking for the sell here, maybe they put their stop loss at this point here. So what the market makers, or what the market did, is just they created the highest point that they created the movement that take these people who were want to sell at this point, and then also take their stop losses. So after taking their stop losses, it means they have been manipulated by the market. So after their stop loss being taken, they know that after because at the first time they saw, they thought that this was the resistance. So they know that if the resistance is broken, it turns into support. So they will try to put the buy entries or buy orders at this point, but also the stop loss maybe at this low or between here, So what the market did again, the market just breaks this low, this invalidation here. So after the market breaks this invalidation here, we have this structure which we call liquidity engineering, this kind of structure. So as I said before, I won't explain deeply about this structure, but that is how liquidity engineering looks. So liquidity engineering looks like this from uptrend to downtrend. This is the liquidity engineering. This is the liquidity engineering, because the market took some orders of some traders from this point. So this is what we call liquidity engineering. But also in the downtrend, the market when the market created something like this, this is the liquidity engineering. So let's see how we can trade this liquidity engineering. Before showing you how to trade them, I would like to talk about 3 types of liquidity engineering that you have to know, but also to consider if you want to get the great result on when you are looking for the liquidity engineering. The first type of liquidity engineering, we call it simple liquidity engineering. So simple liquidity engineering is just a simple liquidity or normal liquidity engineering. It's look like this. The market just breaks up and then breaks down like this. We have the transition. So this previous higher here, this is where you put your entry, and this furthermost deviation, this is the furthermost deviation, is where you put your stop loss. So this is the entry, but this is the stop loss. So what you are expecting is that the market must come to this point to tap and then moves down. That is the simple liquidity engineering in there. When you try to find the sell entry, but if you want to find the buy entry, the liquidity engineering from the bearish to bullish, the market breaks this area here. This is the transition. After the transition, this was the break of market structure. So this previous lower lows before this lower high being broken, this is the area that we have to put our entry point, but also this will be our furthermost deviation. So this is the area where we will put our stop loss. So if the market come to this point, we'll take the entry and then moves above. But the next liquidity engineering, we call it compressive liquidity engineering. So compressive liquidity engineering looks like this. The market just created high then low, and then breaks above this point, but also this point, and also breaks below this point here. So our entry will be at this point here. This is where you have to put your entry, because this low has been broken, and this was the last low, or the last low broken. So this low was formed by this high, but this high was formed by this low, and this low was formed by this high here. So because this is the low that has been broken, we use its high as the entry, because its high is this one and not this one. This high forms this low, but this high forms this low, and this is the low that has been broken. So this will be our entry point. So the market will come to this point, take the entry, and then moves down. That is how this compressive liquidity works, trust me. And in the buying scenario, you will see like something like this, and then breaks above at this point. So because this is the highest point that has been broken, the low, its low will be the entry point. So the market will come to this point and then moves up. That is the compressive liquidity engineering. The last thing is the simple compressive liquidity engineering. This is very, very simple. It's look like this. The price just created high, then low, structure inside, and then high, breaks above, and then breaks low. So because this is the low, the last low that has been broken, this is the high that forms that low. So because this high forms the low that has been broken, this high will be the end point. That is the simple compressive liquidity engineering. But in the buying scenario, you will face this case like this. So the market just breaks that down, and then this will be the entry point to take your entry and then move. So that is the liquidity engineering. Let's try to find, I want to show you some of this liquidity engineering, especially compressive and simple compressive. For example, this example here, if I zoom closely, you can see that the market created the low, high, then low, then high, and breaks below this point. As you can see, this was the low, high, and then breaks below. So after that, the market also breaks above this point here. This point here. Let me try to open this structure in Microsoft Edge so that I can explain to you very closely. So let me zoom it. Let me try to. You see this point here? You see this point here, this point here, this point here. You can see the price just created low, and then high, then low, then high, and then breaks below this point. And also the market came and breaks the this highest point at this point here, breaks this high here. So after that breaks, it means the market is already created the compressive liquidity engineering. So the here is where we have to put our entry, and not this point. The market won't come to this point unless there is some liquidity inside this area. So if there is no, just use this as your entry point. So when you go back to our example, you can see that the market just came to that. You can see the market didn't tap this lowest point here, didn't tap. But if you put your entry to this candle, this red candle here, the market will tap that area, as you can see. So that was the first example about this compressive liquidity engineering. But the next example was this one. This one was the simple compressive liquidity engineering. What you can see is that the market just created the low, high, then the structure inside, and then breaks below, and then breaks above. So it means this is the area that the entry must be located. As you can see, the market just came and then tapped to that entry, simple compressive liquidity engineering, and then moves above. That was the simple compressive liquidity engineering. Also, this was the compressive liquidity engineering. We have two types of liquidity engineering. This is the normal liquidity engineering or simple liquidity engineering, but also we have this compressive liquidity engineering. As you can see, the market created low, high, low, then breaks above. So because this is the highest point that has been broken, we use its low as the entry. As you can see, this was the low, and the market has been the market just tapped to that point, and this market went up it went up. I think I screenshot this entry on, I think it was the weekend, but the market went above. So after taking that compressive liquidity, just the market went above. So that is how this compressive liquidity engineering was taken. But also, this was the simple liquidity engineering. As you can see, the price just created high, low, high, and then the market breaks below. So it creates this structure, and this is our simple liquidity engineering. So as you can see, the market just came to that point and then tap, then moves down. Yeah. So another example, let's see if we can find another example. Or this one. This was just a simple liquidity engineering, and as you can see, the market just came to the low, created the low, high, low, and then breaks above. So this was the liquidity engineering, and then the market just came to take that point and then moves again. So this is the simple compressive liquidity engineering, because we see that the market just created the high and then the low, and then created the inside structure. As you can see, this structure didn't break this high here, so it is inside before this break here. So after the break, the market also came and breaks below this point. So where do you have to put your entry? At this area here. This is where you have to put your sell entry. As you can see, the market just came and then tapped to that point and then moves below. And this was another example of compressive liquidity engineering. As you can see, the market just created the low, high, and then breaks below this row here, breaks below, and then breaks above. So after that, the market must come to this low here, not this one, because we know that if there is no liquidity inside this point, the market will end at this point, will just tap this point and then moves. The market won't take this area here. As you can see, the market just didn't even tap that area. Let me try to mark this point here. Let me try. You can see by yourself here. This is the area where you, maybe if you know the simple liquidity engineering, you just put your entry at this point. But if you know the compressive, you will put at this point, and the market just tap the compressive liquidity engineering and moves. It didn't tap this simple liquidity engineering. So that is how you have to identify simple compressive, but also compressive liquidity engineering. So this is the some structures of these scenarios. Yeah. So after saying that, let's try to find a little more of examples. Maybe I think it's fine. But what I have to tell you is that don't use 1 hour liquidity engineering. This is not the liquidity engineering. If you see this structure in the 1 hour, 4 hours, weekly, daily, monthly, this is not the liquidity engineering. This is the reversal. Why we say this is the reversal is because if you will use it as the liquidity engineering, let's say in the 4 hours or 1 hour, this price may give you may provide you the highest risk. Maybe the stop loss can be 30, 40 pips and above maybe. So that's why we don't use the 1 hour to trade the liquidity engineering. If you want to trade the liquidity engineering very clearly or perfect, you have to use the 15 minutes and below, 5, 3, 1, even 30 seconds. So just use this time frame, because from this 15 minutes time frame to 5 minutes, 3 minutes, 1 hour, 1 minute and 30 seconds, you can use either body to body breakout. What I mean is that you can even use this what we call body to body breakout. I mean, for instance, this area here. You see this area here? When I say body to body, is this one. The market, this body was broken by this body, but this wick was not broken by this body. So this is what we call body to body breakout. So if you are in 15 minutes, this will be your liquidity engineering. But if you are in the 1 hour, you won't take this as your liquidity engineering, because you have to make sure the market breaks your entry, breaks your zone with the body, and you have to make sure the wick to body breakout card in order for you to consider the 1 hour liquidity engineering.